All right. Welcome, everyone. Thank you for joining us for this transition plan webinar. As you get settled, a few reminders before we get started. Please use the Q&A section for any questions today, and remember to be constructive in any of those questions or comments to the presenters and to one another to ensure that we have a session that is productive. All questions will be kept until the end, where we will have a little bit of time for Q&A with the presenters. Also, AIA California will submit one AIA Learning Unit for those who complete this session live. And as always, the webinar content and additional resources will be available online shortly after the session. Today's webinar will provide a better understanding of how to structure a transition framework that balances the professional, financial, and legal concerns of buyers and sellers. It qualifies for one AIA Learning Unit for those who watch live, which AIA California will report to you once you have finished the full session. Now, to quickly introduce our presenters. As a strategic advisor, a former managing principal of an architecture firm and advisory group chair of AIA's Practice Management Knowledge Community, Michael Strogoff, FAIA, provides an in-depth understanding of the architecture industry. Michael authored the chapter on ownership transitions for the 15th edition of AIA's Architect Handbook of Professional Practice. Michael guides firms nationwide in strategic planning, financial management, leadership and strategic retreats, and ownership transitions. Jennifer Suzuki is a corporate attorney specializing in the representation of architects and design professionals. Her practice focuses on internal and external ownership transitions programs. She has over 30 years of experience successfully assisting clients with their corporate transactions. Jennifer has been a speaker and an author on various corporate law topics, including authoring the Professional Corporations chapter of the Bancroft-Whitney California Transaction Guide. Now, on to today's presentation. Welcome, Michael and Jennifer. Thank you both for being here today.
Thank you, Rebecca.
Thank you, Rebecca. And let me get my PowerPoint going. Thank you, Rebecca, and thank you to AIA California for all the webinars that you do. It's a tremendous value, and we all appreciate it. Jennifer, nice to see you again. Jennifer and I work on a lot of transitions together, usually on the same side, but sometimes on different sides of the transactions. And for those that don't know Jennifer, she is one of the few go-to attorneys in the state of California for transitions and mergers and acquisitions.
Thank you, Michael.
Of course. We have a lot to talk about today. And so this is going to be a somewhat high level. There's some topics in there, that deserve a webinar in itself. And Jennifer and I are available after to have discussions after the webinar today. And we will reserve about 10 minutes at the end for some discussions. You can see the agenda. Let's see if I can see the agenda there. There you go. So we're going to start with a kind of an overview, different types of transitions and why consider ownership. We're going to talk about some questions and myths that Jennifer and I hear quite often and try to dispel some of those. Then we're going to move into how to make things successful. We're going to briefly talk about valuations and then focus on how to make things affordable and attractive. And then we're going to conclude on where to start and a lot of the legal documentation that is necessary to make this successful. So, Jennifer, with that, let me hand it over to you to talk about the types of transitions.
Thank you, Michael. And thank you, everyone, for joining us today. I think we're going to start on this slide by really just, here we have outlined, planned transitions and unplanned transitions. I mean, basically, what we want is a planned transition. We don't want to fall into that unplanned transitions camp. There's, when there is an owner and you don't plan for their exit and there's a death or disability, inevitable life changes, people leaving and going to other firms, that kind of thing. You don't want to be scrambling to try and transition responsibilities. You don't want to be scrambling to negotiate buyout terms. So, the purpose of our presentation today is to talk about these internal ownership transition plans. And really what we're talking about is planning for a strategy to transition ownership. And we're talking primarily about internal ownership transition today, but external ownership or a sale to another firm is also an exit strategy. The point is, it is prudent for every owner of a firm, whether it's an architectural firm or any other professional practice or business, it's prudent for the owners to have an exit strategy.
Yeah, what we don't like is the phone calls of, hey, or the majority owner just announced that he or she wants to step down next year. What do we do? Or I want to transition out, but I haven't groomed anyone to step up and offer ownership to do. What do we do? So, as Jennifer said, having these planned transitions is absolutely essential.
And having a gradual
Yes.
redemption's also really great, because then you're avoiding this cliff, right, that happens if someone's just, selling out their entire chunk all at one time. That creates a financial burden, and not kind of phasing other people in to various responsibilities. That's much preferred over a sudden change, the next day. So that's what we mean by, the gradual transition, redemptions and transitions. Okay, the next slide is mine as well. So some of the challenges that Michael and I see with ownership transitions, internal transitions, if we have a bunch of owners who are all around the same age, approaching retirement about the same time, obviously that creates a financial burden on the corporation, potentially, in having to fund the buyout of all of those individuals, as well as transitioning a lot of different responsibilities and roles all at one time. So optimally, we would have different classes, more people. We have like a group of people in different classes, so that we're not transitioning a whole bunch of people all at one time and then leaving just a few others to try and pick up all the slack.
The other aspect of that, if I can just jump in for a minute, is that just the demographics right now. Before the pandemic, we saw that there was a lot of owners approaching retirement, starting to look for a transition plan. And many of these people put that off during the pandemic for obvious reasons. And most of the firms we talked to had a very good 2023 and great prospects moving forward. And they're now looking again at, what is my exit plan? And so there's a lot of people looking for transferring ownership, and probably not as many available that might be interested. So that's another aspect to this numbers game.
Also a big group of aging baby boomers.
Yes, yes.
And not that many people, shockingly, going into architecture. I mean, us lawyers are a dime a dozen, but not as many architects. So there is certainly a demand. So some other challenges we see: situations where owners are not ready to relinquish or even share control. It's understandable that overnight you're not going to want to turn over ownership control to a new owner. But we've seen cases where people don't even really want to be accountable, or they're uncomfortable with really giving new owners a say in decisions. So that can be a challenge, and finding the right balance is key there. Kind of a related challenge is willingness or unwillingness to share information. I think that, I mean, it depends on the size of the firm. Obviously, if you have a lot of owners, it's a large firm, every shareholder is not going to be involved in every decision. You've got to, funnel things to an efficient executive committee and board and whatnot. But in a smaller corporation or other type of legal entity, I think when you bring in new owners, there should be a feeling of inclusivity. I mean, you're accountable to these people. The control group is accountable to them, but also, being willing to share information is really important to making someone feel like they actually are a meaningful owner.
Well, the other aspect of that is when people are considering ownership, it's what information do I have access to? How am I going to be involved? What do I have? I'm investing money in this. What say do I have? So that sharing of information is critical to attracting people to ownership as well.
Right. And to Michael's point earlier, there's a lot of competition for talent out there. And, we see, I don't want to generalize, but certainly I feel like there's been kind of a shift in as we go through each generation. And I feel like a lot of the current generation of younger owners that I meet, my kids included, have a very strong desire to maintain a work-life balance. And in that case, they're not looking to work, the 60, 80, 100-hour weeks. They're really looking for, a more manageable work-life balance, and how that translates to what's needed to run an organization, like the business side of it, the administrative side of it, in addition to, servicing the clients and getting projects done. That can be a challenge that needs to be balanced. And then quickly, the last ones here are listed: fear of the unknown, fear of risk, liability. I think to come in as an owner, there has to be a certain mindset that, inherently as an owner, there's going to be risk. Now, you can manage the risk to some degree, having good contracts, having good insurance. They're all different kinds of mechanisms you can consider. But, when things are bad, who are the first ones to take a pay cut or not take home a salary? It's the owners. Corporations provide some degree of limited liability, but the reality is you're going to have a hard time getting a line of credit from a bank without putting up a personal guarantee. So some risk is inevitable, and an owner has to be comfortable with that. And then the last point here on this slide is, we want owners to come into these programs to have some personal investment in this. Some people call it skin in the game. I think that having some financial resources, either to invest in the firm or at least to cover tax consequences of receiving shares as a stock bonus or stock grant, having some financial resources to put back in if you run out of money, those are all things that we need from an owner, and that can sometimes be a challenge.
Okay, so we covered a little about why transition planning is important. I just wanted to add a few things to this, that unlike an outside sale, merger, or an acquisition, if you go the route of an internal transition, you tend to have more say in perpetuating the firm's culture, the values, the way you do business, and finding people that embrace those values, that culture. Internal transitions are a way of perpetuating that. It is a way of attracting, retaining, recognizing key people. We hear more too often that owners have waited too long and have been talking about transition plans, but not acting on them. And some people who are very entrepreneurial tend to look elsewhere where the opportunities may exist for ownership. And so it definitely is a retention and even attracting new owners to saying we have an ownership framework in place. We've been through this before. We have a roadmap and there is a pathway for you. Will help you attract some really talented people. Ownership provides people with perhaps a more effective marketing platform. And so ongoing growth, ongoing more people with as seen as representative of the firm with the weight of the title of principal or owner or partner or whatever it may be. Certainly from a outside perspective is very positive. It also enables existing owners to redefine their roles. At some point, some people might want to either get back to the drawing board or get back to projects or get away from the accounting or HR. And as you think about which people to offer ownership to, it's also an opportunity to look at what do I want to be doing? How do I want to change my role? Perhaps I want to start working fewer hours and start phasing out or focusing on a specific thing. So we do see that a lot. The value of bringing additional perspectives. Jennifer talked about inclusivity, and part of that is bringing additional perspectives to the table that might mirror the office as a whole a bit better than currently. Timing wise, we'll get into a little later, but it typically, I would say, Jennifer, it takes 5 to 7 years to really do a very orderly succession plan. You could do it faster if you've got a lot of qualified people that are interested, but it does take time to do. But if you do it well, it does enable, as you're making it attractive and affordable, that people that are retiring, redeeming, and so on, that they could realize the value for everything that they have built up. And Jennifer, I know you had some comments about professional liability, that it's a way of making sure that's continued.
Yeah, absolutely. So it gets back to this whole idea of having an exit strategy. So as a existing firm with its owners, when the owners are ready to retire or, in case of death, what are the exit strategies? I mean, primarily they're internal ownership, external sale, or you shut down the firm and you liquidate. Well, if you do that, then you're really not realizing any value of what you've built over the years.
Right.
And so, when we're talking about liquidation of a firm, you have professional liability insurance issues to deal with. Professional liability insurance is written on what's called a claims-made basis, meaning the insurance has to be in place at the time the claim is made. So it doesn't matter that you carried all this insurance for 40 years. If you shut down the firm and then you cancel the insurance and a claim comes in a week later, there's no coverage. So when firms are liquidating and shutting down, most people purchase what's called a tail policy or an extended reporting endorsement. Pardon me?
Go on.
An ERP.
There you go.
Yeah. And so that will provide extended coverage in case a claim is made during that ERP or tail period. They're typically sold for 3 or 5 year terms. The premium is often built right into your policy. Often it's like you can get 3 years of additional coverage and the premium is 200% of the annual premium. And then that'll cover you for 3 more years. But a big drawback of a tail is that a tail provides a single limit for the entire term of the tail. So say you have a $2 million policy on the tail and you use it all up, on attorney's fees and settling a claim in year one, yeah, you have 2 more years left on the tail, but there are no more limits available. Whereas with a practice policy, the limits refresh annually when you renew. And so the beauty of an internal ownership program is that professional liability insurance is going to continue as is from year to year. And those policy limits will be intact and refresh every year. And if the firm continues for another 20 years, that coverage is going to remain in place for another 20 years.
Yeah, and it typically covers, you know, if you're going to retire, what you did during the time when you were active, depending on when the claim is made. So if you want to enjoy your retirement and not be stressed out about some claim coming because you signed some drawings, the best way is for your firm to continue operating and having that succession plan in place.
And particularly because the statute of repose is so long. I mean, you know, for construction defect claims, it could be as long as 10 years from substantial completion. And we're talking about personal injury claims. It doesn't even matter when the project was finished because those kinds of claims can be brought anytime within 2 years of the date of injury, regardless of when the project was finished.
Okay, so more positive news. Attorneys are very valuable and they're great at looking at preventing what could go wrong. But there's also a very positive aspect of considering ownership. And that is, it is an opportunity to shape the firm's future. And for me, when I became an owner, it was a great opportunity to grow professionally, personally. And the recognition is nice. But, you know, it's definitely for those who are entrepreneurial. It could be a great investment. It's not guaranteed. There's risks involved, but it could also be really a potential for increased income if everything goes as planned. You have access to more information. You have a seat at the table. You have greater and greater involvement in decision making as your ownership percentage goes up. And it's a long-term investment opportunity. It's not a short-term, you know, I'm going to buy some things. If the stock goes up, I'll trade it next year. I'll sell, I'll buy it back. It's a long-term investment opportunity. But if things go well, it could be one of the best investment opportunities that is available.
And it's an opportunity to really, you know, enjoy the rewards from your efforts.
Absolutely.
You contribute to the profitability of the organization and you get that back usually in some form.
Right. So a couple of myths. Whoops, did I go past the myth? Okay. Yep, here we go. One of the myths is, well, aren't we going to get a lot more money if we sell externally? And the answer is, it depends. It depends on one's time horizon. And I would say that if you own a firm or a piece of a firm and you have 3 or 4 or longer years to continue, that you're probably going to realize more money with an internal transition. It's a bit counterintuitive because outside acquisitions, yes, the value might be 25 or 50% higher. But with an internal transition, you continue to own some of the firm if it's done gradually, and you are continuing to realize and getting profit distributions based on ongoing profitability. So there's a cutoff point or a crossover point of 2 or 3, sometimes 4 years, that after that time, you're better off with an internal transition and you still own a piece of the firm. So there is that consideration. So don't automatically assume that you're going to be better off financially with an outside acquisition. There might be other reasons to do an outside acquisition, but it's not a foregone conclusion that that's going to net you more. The next one is you only need a valuation when some event happens. And that goes into the next one. So sometimes we see in buy-sell agreements that the transactions would be at the fair market value. And that's like just punting it down the road. That fair market value in itself is a very subjective thing. Because typically with a fair market value, the provision is that each party to the transaction will select a valuation consultant or an accountant. And if they can't agree on something, then they'll select another accountant. And really what you're doing is setting yourself up for a dispute. So it's so much better to have a valuation that everybody agrees to, signs off on, that's valid for the coming year, and to have that before you need it.
The IRS defines fair market value as what a willing buyer would pay and what a willing seller would sell at.
Yes, keeps lots of attorneys in business, right? And lots of accountants in business.
Right. Michael, is this a cue for me to just briefly touch on the last 2 points?
Yeah, briefly. Please.
I mean, we've already talked about, that we have plenty of time. I mean, Michael mentioned the 5 to 7 year time frame. I mean, it does take time to mentor new owners, and it takes time to allow for a gradual transition. Ideally, we like to have people who own a large block of shares to sell over a 5 or 6 year period, 4, 5, 6 year period, not all at one time. So to allow for that to happen, you can't wait until like, oh, I'm ready to retire next year. Let me look at, ownership transition. Now, sometimes we do get involved when that happens, when people come to us. And, sometimes it's fortunate the firm has the right people there who are able to get up to speed quickly. But more often than not, it's really hard to do it the year before if you don't have the right people in place and you really haven't planned for it.
And it puts a lot of financial stress on the firm if there's a large buyout. Even if that buyout is over 3 or 5 years, it could put a lot of financial stress on the firm if it's too large of a percentage.
Right. And, the fact that, this myth about staff will remain forever loyal. I mean, this generation particularly, I think it's pretty normal for people to move around every few years to, see, what it might look like at another firm, to try something different. I feel like an old person saying this, but certainly, I started with, I've been with Long and Levitt for, like 25 years, over 25 years. And, that's probably these days the exception. And so the idea that if someone isn't feeling like they're being rewarded for their efforts, not being recognized, they're going to leave. People, no matter how much they like the owners, the reality is that people do move around a lot.
So basic ingredients, and I was thinking when we were putting this together, I need a visual. So I just looked down on my cutting board and there it was, because I know architects like to cook. But the basic ingredients for a successful transition, basically you need ongoing profitability, because it's the profits that people are buying into, and it's the profits that fund redemptions. And if you have a firm that doesn't have ongoing profits, it's difficult. So you need ongoing profitability, you need qualified and interested leaders, and you need time, as Jennifer just mentioned. And I want to talk about these last 2 things, qualified and interested leaders and time, because profitability is much easier to understand. And we help firms, and every firm's list is different. But from our work with a lot of architecture and related design firms, we have a list of criteria that people use as a starting point, and this is just some of them up there. That tends to be about 3 times this amount. But shared values, belief in the firm's vision, trust, integrity, because it's like a marriage, they say, and you've got to be able to trust your partners, and they have to have sound judgment, and they have to be able to think strategically about the future. And probably the most important thing is this 4th one, that, and I think this is what separates owners from non-owners, well, some non-owners, is this mindset that what is best for the firm takes precedent over what is best for any single individual. And people need to have that mindset if they're considering ownership or if you're considering offering ownership to someone. Strong interpersonal skills, constructive communications, just this willingness to talk about difficult topics. It's basic leadership, right? And as Jennifer mentioned before, tolerance and willingness to assume appropriate risks. You can manage risks, but probably I would say the top reason that some people decline offers of ownership is that their comfort zone is not wide enough. There's a lot of ambiguity that goes with being an owner. It's a 24-hour-a-day job. And for a lot of people, that's fine. They can handle that. For some people or their significant others, it's just outside their comfort zone. And that's fine. That's fine if they decline ownership. But it does take that comfort zone. And I want to talk about time a little. And this is just a little kind of fun graph. We all know the phases of doing architecture, of schematic design, design development, so on. And these are the phases that you might see as becoming an owner, that you're excited when you start, right? And then after, so many years or whatever, you go, oh, this is hard work. It's the realism sets in. And that might last for 10, 15, 20, 30 years. And then at some point, if you stay too long, you get disillusioned. You'd rather be home, playing with your dog or cat. I don't want to get this political, so I'll say cat as well. So, but if you wait too long, you kind of enter that last zone of you no longer give a shit. Can I say that, Rebecca? I think I can say that. So, and the point of this graph, kind of a fun graph, is just you want to start your transition plan way before you reach the disillusionment stage. You want to start it when you're really engaged with the firm, when you're excited, when it's a good time to do it. The best time to start transitioning is when things are going really well. But don't wait too long.
Yeah, and as a follow-up to that, I mean, based on everything Michael's just been talking about, in terms of criteria for success, you have to have willing buyers with the right mindset, and you have to have willing sellers who are willing to engage on all those different factors we talked about earlier. What's helpful in an ownership transition program is if the firm can demonstrate how ownership provides an upside and benefits that employees do not receive. Like, what do I get out of this by being a shareholder that I'm not already receiving as an employee? That could be a share in the profits, meaning that, there's a financial aspect to it, typically, maybe more higher compensation, different pool of benefits available to owners, and this profit sharing. Having some ability to know what's going on and have a little bit more control over your professional life, in that you have a seat at the table, as Michael said, an ability to provide input, having a professional title. Those are all things that typically, an incoming candidate will kind of consider as, yeah, there are positive reasons for me to do that. And then we would balance that, which comes in a later slide, with looking at, well, what are potential risks or downsides of stock ownership? And we'll talk about those downsides in a later slide.
Yep. So I'll move on to the last thing of Jennifer talked about relinquishing control, and that often is one of the most difficult things to do. And so to make it successful, people that are owners need to be willing to say, okay, I'm going to give up some control. Actually, if you're not willing to do that, you're probably not going to attract people as co-owners with you. And must be attractive and affordable and develop a roadmap. So let me talk about those two things. This is a sample roadmap. And just for illustrations only, And basically, when we do this, we look at 10 or 12 years, and we look at the existing owners. What do they own? When do they want to start? What are each of their respective time horizons? When does each person want to start divesting? And how many owners do you foresee in the future, and when? And this is only a roadmap because things happen and firms change and evolve. But it's a plan that you can say, okay, we want at some point to get up to equal ownership for 6 people, or I want to have majority control at some point, but I want partners, or whatever it may be. Having this roadmap is going to give you some sense of how many people you want to bring in and at what point.
And what goes hand in hand with this is having some sense of what your ownership criteria might be.
Absolutely.
You know, some firms, you know, if you're organized as a professional corporation, then, you know, you need to be licensed. You know, some firms, you know, you have to demonstrate either that you can bring in work or that you have been bringing in work. So every firm's different, but, you know, the criteria then would play into this roadmap that Michael is showing you.
Yeah. The other important thing, and then I'll jump to the affordability, is to proactively recognize and engage in constructive dialogue about what potential concerns might be, because it is something that people don't know about is, you know, if I stamp drawings as an owner, or what type of personal guarantees might I need to make, or what happens if the firm doesn't do well, or what type of governance is there, and how are decisions made, and what decisions do I have a say in, and at what point do I need to personally guarantee things, and at what level? If some other partner does something that's negligent, am I responsible for that? And these are all good questions, and you can probably expand this list to you know, a dozen different things. But the point is to think about these things from the perspective of people that you're offering ownership to, and address it, and talk about the risks and how you manage it, talk about the type of insurance you have and how that protects. And then because you have to alleviate their concerns. And at the same time, if you have people that look at this and they have concerns and they don't have that comfort zone, then they should not really enter into ownership, because it's not meant for everybody. It doesn't fit everybody.
I think as a lawyer working on these ownership transition programs, what I find to be very helpful from the outset when we present a term sheet is describing for people, you know, what it means to be a shareholder in a corporation, or if it's a limited liability partnership, what it means to be a partner in that LLP. So because I feel like there's a lot of misconception out there in terms of what, you know, liability you have as a shareholder or as an owner. And it really depends on, you know, with LLPs and with corporations, there is some limited liability protection. And so I think, you know, people have to understand that just because you're a shareholder in a corporation, using that's the primary entities we use, you're not personally liable just because you're a shareholder. However, you know, depending on the size of the corporation, what you're responsible for, as a shareholder, you may be asked to provide a personal guarantee for the corporation's line of credit. You might be asked to assume responsible control for certain projects and sign and stamp them. In a corporation, you have personal liability for your own negligence. You don't have personal liability for the negligence of others, but as to your own negligence, you do have personal liability exposure. And most of the time, that risk is covered by insurance, and, good QA/QC, good contract, terms and whatnot. But I find that a lot of times people come into a corporation setting and really don't quite know what the default liability rules are for a shareholder.
Yeah, and often, Jennifer, correct me if I'm wrong, there's some type of cross indemnification so that if you're a 5% owner, you would typically only be responsible for 5% of the firm's liabilities.
Often there's an internal agreement that addresses some of that proportionate allocation of liability. And then it's not on it wasn't on our last slide about potential concerns, but I will mention that a lot of our programs will have some post-termination restrictions, like a non-solicitation covenant, which is completely different than a non-compete. But those also have to be considered in terms of, what are some of the concerns of the existing owners if things don't work out and someone leaves? Do we have restrictions which incoming shareholders can live with? So that's also...
Yeah, and it needs to be balanced. If you have too onerous of restrictions, you're not going to attract people to ownership. So that's part of what makes it work. There was a question about what's the difference between a principal of a firm versus an owner. An owner is, the way we're using it, is somebody that has a financial ownership stake. Some firms have principals that are not shareholders or owners. Some have a different name for them. Some use partners, principals, associate principals. We're using owner in the context of somebody that has actually financial, legal ownership of a firm.
In other words, equity ownership.
Equity ownership.
Where you're potentially, at risk.
Yeah. So we have about 8 minutes left before we turn this over to some questions. So we're going to go through these kind of fast. And valuations, it's a topic of an entirely different webinar, long webinar, but basically it has to be affordable. The best valuations consist of tangible value, which is kind of the book value, your cash assets, depreciated value of equipment minus all your liabilities, but it has a profitability component, the intangible value. It's what we a lot of times call goodwill, which is really a reflection of the likelihood of future profitability. And what goes into that intangible value is the quality of your staff, your portfolio, your network, marketing network, the backlog that you have, your claims history, basically the likelihood of people are buying into, because ownership it's primarily a financial transaction. I mean, there's a lot of other things that we talked about, but it's a financial transaction. So the valuation has to account for the likelihood of future profitability. And if it doesn't account for that, if it's just like some multiple of book value, that two firms, same book value, one firm's highly profitable, the other firm's losing money, they're not worth the same. Now, for some instances, a simple formula like that might be okay. For most instances, we like to see a component of it linked to future profitability, or a reflection of the likelihood of future profitability. The other thing about valuations is it needs to be clearly prescribed. If you cannot reduce a valuation to a formula that is easily understood, then it's not a valid valuation. It's ambiguous. And so it's very important that whoever does your valuations can also provide a very prescriptive formula for how it's calculated and recalculated every year. And then finally, it's a default value. And this is really important, that the valuation is one data point. It's the controlling data point. If something unplanned happens, or even if it's planned, that's where you start. It's always open by agreement to change it. If you're trying to attract somebody in, you can choose this. You can choose to discount it. If you have someone who left, depending on the reasons, you could choose to negotiate the value, but it is the default value, and it should be clearly defined. And optimally good housekeeping is to update it once a year so that, as I said, it's the value before some triggering event.
And Michael, I would add that, yes, I agree that by mutual agreement, the parties can certainly agree to something that's different from what's in their agreement. But I think it's also good for consistency to try and stick with, the same, through all
It
your
is.
transactions.
Yes.
And then, but I get it. There might be business reasons
Yep.
why in a particular instance something should be discounted, but then you need to be prepared to explain then why that's not a precedent for
Exactly. And they should also account for, for the risk factors. A good valuation will tell you how it accounted for the different risk factors, that might be dependence on key personnel or a few clients, or that there's no, unlike buying something that's publicly traded, it's a very limited market. So it should address all those things. Somebody had a really important question about where is this photograph of these two people chatting taken. So it was taken in Cuba, in Havana Square. They do an art installation once a year, and we happened to be there when Obama and the Rolling Stones were there, and we saw this statue. So it's some things about affordability, and this is where, you got a value, but it also depends on the terms. It's how much net worth goes along with that, how much is allocated to the existing owners through some type of dividend payable or deferred compensation. So that could change the value up or down dollar for dollar. You could offer the in increments so that it's more affordable. People buy a little, they earn the profits. They could use some of the profits to buy some more. So that's why that 5 to 7 years is so important. And that's one of the keys to making it affordable. The valuation amount that, whatever valuation you decide on, you need to test it. Is it affordable? Can people afford this? Because you have to have that willing buyer and willing seller. Can't just have a willing seller. And so you can think like your house is worth best house on the planet, but if there's no buyer for it, it's not worth that much. The amount of down payment, some skin in the game. It could be any place from 0 to 10, 20, $30,000. You could choose to discount an initial purchase to help people jumpstart it. You could choose to bonus them some subsidy to help them jumpstart it. You could choose to give them a salary increase once they become an owner. You can make financing available so they don't have to go to the outside market to finance it. You could have relief valves. What happens if the profitability goes down or something? Is that relax the payment term? So there's a lot of levers to move. So it's not just having the valuation amount, it's looking at all these things when you put together a transition framework. And basically what we do is we look at a kind of a 10-year cash flow. This is just a sample. I know it's a lot to digest in the 45 seconds we have, but basically what we do is we look at between a down payment, financing, loan obligations, and expected share of profit distributions. Is someone going to be cash flow positive or negative at the end of each year? And as Jennifer said, if they're not going to be better off than just staying as a highly paid employee, then it becomes a more difficult decision. So we test the valuations based on how does a cash flow, depending on the terms that are looked at. So in the 2 minutes we have left, Jennifer, where to start?
Yeah, I mean, I think that, first thing is gathering up your advisory team. Having a financial consultant like yourself on board is great. Having a CPA or other tax professional, and then having an attorney. Usually those are, the core members of the team. There could be questions for the insurance broker sometimes, but those are the 3 key people that I'm usually working in a team with on these programs. In terms of where you start in terms of documentation, we usually like to have a term sheet that outlines some basic terms, 2 or 3 pages max, just business terms, high-level overview of what the program looks like. How much are you offering? What percentage does that represent? What's the financial commitment? What are some of the other, conditions of ownership? Giving people that sense of an overview. They use that term sheet to say yes, on the basis of that, yes or no. It's not binding, but that's the foundation in which the parties then proceed. And then in terms of the package, we normally would prepare a stock purchase agreement. If the current owner is going to be selling some of their shares, at the same time that the shares are being offered, so that essentially that person is being paid for the dilution, then we'll see some sort of stock repurchase or redemption agreement. There might be promissory notes if there are payments that are being financed. A pledge agreement is just basically where someone agrees that I'm going to put up the shares that I'm buying as collateral to secure the promissory note. So if I default on payment, then you can take those shares back. A buy-sell agreement, that's one of the key agreements that you'll need. And that in and of itself is another roadmap. It spells out what events trigger either a right or an obligation to buy back the shares. It includes a valuation formula. It lays out the payment terms so that when something happens and people are heated, you're not fighting over the value and payment terms. It's all set out in the agreement itself, and you just plug in numbers and follow it. And then sometimes we will need to update articles of incorporation or bylaws. The most common thing about updating bylaws is expanding the number of directors. If you don't have enough directors authorized in your bylaws, then we would amend them to expand.
Yeah, and I would say just a little plug for Jennifer, and there's probably half a dozen other or a dozen other really good attorneys in the state that really focus on transition planning. So, find an attorney that understands it, that has gone through it, that knows the issues. It could be very different from someone who just deals with claims. So Jennifer, I'm gonna just kind of questions. There was a question of do you need an appraiser for evaluation? And try not to be self-serving about this. We do valuations. There's other advisory firms that do valuations that are not certified appraisers. There's a lot of certified appraisers. One of the issues with certified appraisers is that to be certified, they have a specific 4 methodologies they have to follow. And they'll do a long report, and then they'll say, well, the first 2 don't apply. So we've seen these long reports. Find a valuation advisor or appraiser that really understands the architectural engineering industries, because there's very different metrics that are used for those than for publicly traded companies or gas stations or whatever.
And I would say it's not all about the valuation, at one specific point in time, which is often like if you go to an appraiser, like you get an appraisal for estate tax purposes, you get this report where it values an asset or a piece of property, based on a snapshot in time. For these types of programs, that's a starting point to understand what we're working with, and then how that squares with expectations of the owners in terms of what they're going to get out of this. But really, I think the primary exercise is coming up with a formula or methodology that we can consistently use and follow. Right. That's really what we're after in terms of a consultant here.
Jennifer, there's a question for you as a licensed architect and owner of a firm. After transitioning out, if there is a claim, but the firm is still in operation, do I personally need professional liability?
So you should be covered. Basically, a professional liability insurance policy covers all the services provided by people who were employees of the company at the time, they provided the services. So even if you've left the firm, you would still be covered under the policy. Now, if the firm then subsequently cancels its insurance, or, you know, goes out of business and doesn't get that tail, then there'd be no coverage for anybody. But typically, the owners would have a vested interest in making sure that there's some coverage that remains in place, at least for some period of time.
And if you sign, there's another question. How about if you sign drawings as an employee and the firm is out of business? There's a lot of employers that wouldn't be willing to sign drawings. So be careful about that. And make sure you're protected and make sure you have something in writing that really protects you if you are signing drawings. But if the firm's out of business, then, that's a tough one. You probably don't have any insurance coverage at that point. And liability follows the licensed professional.
Right.
As a younger professional looking to possibly be an owner, is there any ideas or items we should start on earlier? Yeah, get some good mentors, get some good training programs. Go to some webinars and seminars. Just read it, be a sponge and try to get in on the discussions that the owners have. Ask if you can sit in on a few owners meetings, join some committees in the firm. Lots of things you should do, but get a really good mentor is probably the best thing I can say.
And becoming familiar with the business of architecture, I think, is really helpful, because early on in careers, I think a lot of people are focused on, I want to be the best architect I can be. And yeah, there's a lot to that. But, being an owner means you also understand the business side of it, because, the reality is there are a lot of great architects out there, unfortunately, who are not very financially successful because they don't pay attention to the business side.
Yeah. And, like doctors that go through rotation, get exposed to all aspects of it. What do you suggest for investing in shares? It depends. My personal view is if you're committing with a promissory note and you're taking on those obligations, you should own those shares from day one. But often we put in some restrictions that if you sell those shares back within a certain time frame, you cannot benefit from increases in the share price. So sometimes we put a cap on it for 2, 3, 4 years. Other firms do have vesting programs. So, but I would say probably 3 years or less. And then would a seller or buyer prepare the projected annual cash flow? Well, I think the seller is in the best position to prepare that because they know their financials, they know the projections. But the biggest, do it and then we like to interact with incoming owners to say, well, what if the firm has a couple of banner years and then goes into a downward cycle, and kind of play through all the what ifs so that people can make informed decisions. So anything else I missed, Jennifer, on this?
There's a quick question. Can you buy liability insurance tail if you sign drawings, if the firm is out of business? I believe they do sell that product. So if you contact one of the professional liability insurance brokers, they can give you more information about that. Someone I think we know, thank you for this comment. It wasn't a question as more as to kind of say it's compatibility with the firm's culture is really important. And I couldn't agree more with that comment. That's right on.
Yep, absolutely. Way more important than the financial aspects. If you don't agree with the firm's culture and the values and the way they do business, and you don't have professional respect for the other owners, then it's you have to satisfy all that and then make your financial decision. So we have time for one more question, Jennifer.
I think we're right at one, actually.
Okay, we are at one. I want to just thank everybody for participating, and again, thank you to AIA California for hosting this. Jennifer, thanks for all your expertise. You are a valuable resource to everybody.
Thank you, Michael, and thank you. You've done a a lion's share of the work here in putting this presentation together. Thank you.
Yes, thank you, everybody. Have a good day.
Thank you for attending.